Let me ask you something most traders never really sit with. How many strategies have you actually tested properly? Not eyeballed, not replayed on few charts and thought, this looks decent. But real testing across hundreds of trades within different markets and conditions and different time frames. Once you do the math, something uncomfortable shows up. Manual trading hits a hard limit. Not because of laziness or lack of discipline, but because a human can only do that much. You cannot backtest hundreds of strategies discretionally in a realistic way. And even when you try, your mindset shifts every single session. Your mood, your patience, and your decision making change. That makes the results unstable. And this is where the gap between retail traders and professionals quietly opens. Markets reward repeatable execution under pressure, and humans struggle with that when capital and financial consequences are involved. In this video, I will show you why manual trading breaks down the moment you try to scale it up, how automation removes the emotional and time-based traps traders fall into, and why, especially with prop firms, algorithms tend to be structurally safer. Before we go further, picture one scenario. Two traders, same strategy, same rules, same market. Early on, their results look almost identical. Then drawdowns start to appear. One trader hesitates, skips a setup, cuts lot size in one trade and double it in another trade to recover losses, and start managing trades early to reduce discomfort. The other trader keeps executing. Trade number 37 is handled the exact same way as trade number 1. That's where the real edge shows itself. It was not the strategy, it was who was executing it. Let's start with the first major advantage of algorithmic trading, backtesting. In order to validate a single discretionary strategy properly, you need hundreds of trades across different environments, including trends, ranges, high volatility and low volatility, and news-driven sessions. Multiply this across multiple variations and you're looking at hundreds of hours of work. Even if you push through that, there is a deeper issue underneath. The psychological environment during backtesting does not match live trading. There is no fear when clicking through historical charts, no hesitation, and no pressure. So execution changes once real money is involved. That means that the strategy you tested is not the strategy you actually trade. This is why discretionary backtesting often creates false confidence. The data looks clean, but the environment is artificial. Algorithms don't suffer from this mismatch. With automation, you can test hundreds of strategies variations across years of data quickly and consistently using the same logic and the same execution. You get clear answers about expectancy, drawdown variances, and how the system fails. Just as importantly, weak ideas get eliminated before capital is actually exposed. This process isn't about forecasting, by the way. It's about understanding probability before the market charges tuitions. This is why professionals operate with validated systems and quantitative analysis rather than opinions. Markets do change, which make testing across regimes non-negotiable. Algo trading allows that level of validation. Manual trading does not. And when validation is weak, everything built on top of it becomes unstable. Quick pause here. If this breakdown is already saving you time or clarifying things, hit the like button. It tells me this kind of deep, practical algo trading content is worth making more of, and it helps this video reach traders who actually need it. Emotional bias, the real killer. This is where most trading conversations get uncomfortable. When traders fail, the strategy usually gets blamed. But in practice, that's rarely the root cause, by the way. Most strategies don't collapse on their own. Execution breaks first. You see the same pattern repeatedly. After a few losses, risk gets reduced or even amplified. After a few wins, confidence begins to influence decisions. Entries get delayed, exits get managed early, and rules get bent in small, rationalized way. Not because the traders are reckless, but because uncertainty creates pressure, and pressure changes behavior. Fear shows up after losses, overconfidence follows wins, and there is a natural urge to avoid pain or make losses back quickly. These reactions are normal and human. But markets don't reward what feels normal under stress. An algorithm doesn't register winning or losing streaks. It does not hesitate, close trades early for relief, or change behavior based on recent outcomes. Trade number 1 and trade number 1000 are executed the exact same way. That consistency matters more than most traders realize. Many traders already have a workable edge, but they lack the ability to follow it. Through drawdown without interference, automation addresses that gap by removing the part of the system most likely to sabotage it. The algorithm doesn't make you profitable. It makes you consistent. And without consistency, profitability never gets a chance to emerge. Screen time and attention bottleneck. Manual trading quietly trains you to believe that more screen time equals more control. The charts are open, the sessions are live, and staying engaged feels productive. So you watch, wait, and second guess, especially for intraday and scalping environment. Hours can pass by for a handful of decisions, and even then, entries still get missed, exits get rushed, and fatigue builds in the background. Attention becomes the bottleneck. The longer a trader stays at the market, the more decision quality degrades as reaction time slows. Patience wear thin, and small errors begin to stack up. Automation breaks this cycle by shifting the work upstream. The trader focuses on defining rules, optimizing parameters, and validating behavior through testing, while the system monitors the market continuously without draining mental energy. This matters even more in markets that operate around the clock. Forex, crypto, and global indices, for instance, continue moving while you are working, sleeping, or unavailable. Manual trading cannot realistically cover that, but an algorithm can. Professionals don't value screen time for its own sake. They value leverage of time and attention. Automation allows one trader to operate across multiple instruments and multiple sessions without performance degradation, something manual trading simply does not scale. Precision, speed, and why humans can compete. As trading moves into shorter time frames, execution quality starts to matter more than interpretation. In a scalping or a fast intraday environments, outcomes are often decided not by the idea itself, but by how precisely and consistently that idea is executed. Price moves quickly, conditions shift without warning, and even small delays translate into slippage, missed entries, or poor positioning. Algorithms respond to predefined conditions the moment they appear, execute with fixed parameters, and process multiple signals simultaneously without cognitive load or doubt. Over large sample sizes, that mechanical consistency creates a measurable edge. This is why entire segments of the market, such as high-frequency trading, market making, and institutional execution, are fully automated. This limitation isn't intelligence or experience, it's biology. Human reaction, speed, and precision have hard upper bounds. Even outside extreme high-frequency environment, precision still plays a decisive role. Consistent entries, exact stop placement, fixed position sizing, and uniform risk application quietly compound over time into meaningful performance differences. Manual execution introduces subtle randomness through small delays and moment-to-moment judgment calls. And across hundreds of trades, that noise becomes a persistent drag on performance. Automation removes that variability. For longer-term traders, raw speed matters less, but execution consistency remains critical, which is why many institutions automate execution even for swing and position strategies. The real distinction is not time frame, it's not repeatability. When a strategy can be defined clearly, it can usually be executed more reliably by a system rather than by a human, subject to fatigue and inconsistency. Prop firms, where automation becomes structural advantage. Prop firms' environments expose weaknesses in trading more aggressively than personal accounts. The rules are very rigid and the margins of error are extremely small. The consequences of inconsistency show up quickly. Daily drawdown limits, maximum loss caps, and profit targets are enforced mechanically and do not adapt to how confident or frustrated a trader feels. This is where discretionary trading often struggles. Most prop firm failures don't come from a lack of an edge, by the way. They come from behavior. Traders overtrade after losses, increasing risk emotionally, chase target near the finish line, or bend rules under pressure. Those decisions rarely feel reckless in the moment, they feel justified, but the rules don't care about justification. Automation aligns naturally with this kind of environment because rules can be enforced without negotiations. Risk limits are hard-coded in the expert advisor and trading bots. Position sizing is fixed and trading can pause automatically when predefined conditions are met. Many traders fail prop challenges using discretionary execution and later pass with the same underlying strategy once it's automated. The logic did not change, the execution did. With the right algorithm, automation becomes the safest way to apply prop firm rules and pass challenges, not because it increases returns, but because it reduces the probability of disqualification through emotional error. Algo trading doesn't remove the human from the process. It reassigns the responsibility. Professionals do not hand decision-making to machines. Humans design strategies, define risk boundaries, select the markets, and decide when a system should be active or inactive. Markets are extremely dynamic, and structural shifts happen during macro events, policy changes, or geopolitical shocks. In those moments, the edge is not faster execution, but judgment, knowing when conditions have changed enough to pause, reassess, and redeploy later. Machines execute rules with precision and consistency, while humans provide context, oversight, and adaptability. Creativity belongs in research and strategy development. Discipline belongs in execution. Once those roles are clearly separated, trading stops being an emotional endurance test and becomes a process that can be evaluated, adjusted, and redeployed with intent. If this way of thinking about trading makes sense to you, there is one video that you should watch next. In it, I break down the most important pillars of trading with algorithms, the foundations that actually matter and that save traders months or even years of trial and error. If you want to trade with algos the right way, manage them properly, and avoid the mistakes that quietly destroy most automated traders, click right here to watch this video. See you next week.